Traders, we are back in the mix. Welcome back. Welcome back. Let's go ahead and go over what happened in the markets last week. Obviously, by now, everyone here should have seen the sharp decline in the dollar that we got last week, which primarily came from the Fed interest rate decision that we had last week on Wednesday, where the Fed, so we had a fair amount of players in the market, if you will, who were expecting the Fed to have a surprise rate hike. We didn't get that, right? So the markets were met with some disappointment, initially causing the dollar to edge a bit lower. In addition to that, we also saw that the Bank of Japan intervened last week. I believe it was Thursday. I think it was Thursday. And what happens is when the FX rates between the US and Japan are causing the Japanese yen to stay significantly under pressure, it's just a matter of time before the Bank of Japan is forced to intervene and stimulate their currency. And so what we saw last week after the Fed rate decision was the markets initially sold off, right, from I'd say 101.5. And then we saw a follow through from that sell-off following the, again, statements from the Bank of Japan intervention. Now, what's interesting to me is that we've recently seen the dollar, I guess you could say, kind of bottomed out at 99.5, given the fact that we've got better than expected ISM manufacturing reports, which is a good indication of the labor market, but it's not enough to necessarily move the needle. So that's why we see the dollar find some support at 99.5, but now it comes down to what's going to happen on Friday, right? With payrolls, with the unemployment rate, with wages. And so I think that's where the focus is shifting to right now. Now, on the geopolitical front, actually, before we even get to the geopolitical front, I want to go over this with you guys because I think this is a pretty good insight here from ING. So let's drag that into the screen. ING gives us a good outlook here. Right, this is from today. The dollar can recover some ground if the data allows. So as I mentioned, the focus shifts back to the fundamentals. So they say the dollar is trading on firmer footing at the start of this week with this round of large-scale JPY intervention on the books and a more balanced speculative positioning. A batch of soft US data is needed this week to add more pressure onto the greenback. We see room for some US dollar recovery in the next couple of days. The same here. US dollar, some upside risk this week. The dollar has found some support at the start of this week. This round of Japanese intervention may be over, lifting a key source of further downside risk for the dollar for the remainder of this week. Also, the positioning picture of the US dollar is probably more balanced now compared to a week ago. The reason why they say this is because remember a week ago we had all this uncertainty around the Fed. What's going to happen with the interest rate decision? Are we going to get a hike? Are we not going to get a hike? Are we going to get some sort of forward guidance? We didn't get any of that last week. And so the markets being met with that type of disappointment is what caused the treasuries to fall back, caused the dollar to fall back. And obviously other instruments like your commodities, like gold, for example, caught a bit of a lift, right? Caught some recovery. But according to ING, our calculations based on CFTC figures show aggregate net long US dollar speculative positioning versus reported G9 currencies, G10 excluding NOK and SEK at almost 26% of open interest the date of July's Fed meeting. That was slightly above the peaks of January 2025 and April 2024. And the most overbought the dollar had been since May 2019. If positioning, squaring, exacerbate the dollar sell-off last week, we think further US dollar losses from here require a more compelling macro argument. That is, soft data justifying a new round of dovish repricing. Yesterday's ISM manufacturing surprised to the upside, with strong gains in the employment sub-index. For the rest of the week, the focus is shifting firmly to the jobs market. Today, the focus is on Joel's job openings for June, expected to have slowed to below 7.5. We actually came in at 7.3, which is still not the greatest, right? It's not the worst, but it's not the greatest. But nonetheless, it's not enough to really move the needle, which is why if you go back to the dollar here for a quick moment, you'll see that, yes, the dollar has lost a little bit of steam during New York session, but nothing significant, right? And so the markets, just like most NFP weeks, are probably going to be on a little bit of a standstill moment until we get that payrolls data, wages, unemployment, which right now sits at 4.2%. So obviously, if that starts to edge higher, this could raise some concerns for the labor market. But the main question that everyone's really asking themselves right now is the labor market remaining resilient, or is it not, right? Is the labor market starting to loosen? So that's really the big question that traders have on their minds. And in order for us to get some insight on that, we got to wait for the data on Friday. But I will tell you from my perspective, right? Because there's two themes right now in the market, in my opinion. Number one, you have the fundamentals. So you're paying attention to things like inflation, interest rates, economic output. The second would be your geopolitical. So everything that's happening on the geopolitical front, which if we turn a quick eye over to Forex Factory, drag this into the screen here, you'll see that the latest, according to FX Factory, was that there's potential talks around the reopening of the Strait of Hormuz. What's interesting about this, though, is that we got some commentary from Trump that the Strait of Hormuz is going to be reopening, and then that type of commentary was denied by Iran shortly after. And so we'll see what is the truth versus what's not the truth. But what I will tell you is that we've danced this dance before, like we've been here before. If you've been tracking the pattern that we've been in over the last 30 plus weeks or so, there's been a lot of back and forth. And so what I personally learned through this is not to buy into the headline. Don't get so caught up in the headline and think that the headline is telling you the real story. I think that what matters most is waiting for official statements from both sides. And once you see that, make sure that it's reflecting in the markets, because it's not enough to just look at the headline and say, okay, this is what's happening. You have to go back and see, how is the market digesting these headlines? Is it, are these reactions, are they sticking? Are they not sticking? And so I think that's also playing an important role within the geopolitical front, is not necessarily just the headlines themselves, but hey, is there reaction function coming from the headlines? Are these reaction functions staying in the markets, proving it to be true? Or is the market fading these headlines? And so, for example, this morning with the talks of the reopening of the Strait of Hormuz, technically that would open up the door for further dollar downside, but we haven't necessarily seen that, right? Yes, the dollar is slightly bearish on the session due to the JOLTS job openings, right? The miss on the JOLTS job openings, but it doesn't necessarily show us that the dollar, for example, has been in a massive sell-off. And so the support is still there. The dollar still holding up steady above 99.5. The question here is that going to remain, right? Is that going to be the case as we head into Friday? It's the big unknown. And so my biggest take on this is, I have more reasons to believe that we'll see further dollar upside versus a shift in sentiment and seeing dollar downside continue, unless, this is the big unless we start to see the fundamentals favor dollar downside. So that's why I say you want to be paying very close attention to the data that we get from now, obviously to Friday, and we go from there. But I remain fundamentally a dollar bull. And with that, I also remain a gold bear, where I'm looking for opportunities in the gold market for potential downside. The only problem with gold, though, is that we've been in a very choppy environment, right? We've been getting a whole lot of chop, and not necessarily an environment that I like to position myself into. But of course, if the opportunity presents itself, then there might be something there. But just look at the reaction that we got from the intervention. This is dollar yen. The reaction that we initially got, very similar to the reaction that we got the last time that we got intervention from Japan, which was more of a verbal intervention, right? But this is the reaction that we previously had gotten. You can see how the markets were very choppy, right, as they were edging closer to that 161, 163 handle. And then we started to see, hey, next round of intervention taking place. So I am in some agreement with ING as far as, hey, what are the pros and the cons, right? What's most likely going to be supported for the dollar versus what can cause a shift in sentiment to favor dollar downside. So I am in agreement that I do think that dollar pullbacks that we've seen are going to be limited. They're going to be capped to some extent, with the assumption that the fundamentals will back up that narrative, right? Will back up that idea. But that's more or less how I'm positioning myself for payrolls on Friday. Hopefully you guys got value from this, and we'll see what ends up happening then.